Why does the market move the way it does? And how can understanding its basic principles actually make trading easier? Today, we're diving into market activity, one of the key things that shape price movements. Many traders overcomplicate things, but the truth is, the market follows pretty simple logic. All right, let's jump in. Think of it this way. Every trade happens because someone wants to buy and someone else is willing to sell. The more people actively looking to trade, the more movement we see. If demand is high, prices go up. If supply is stronger, prices drop. Nothing fancy, just basic economics in action. And here's something important. The market isn't a one-way street. If prices get too high, buyers step back. If they drop too low, sellers lose interest. It's this constant balance or imbalance between buyers and sellers that creates opportunities. Understanding this simple mechanic helps you make better decisions without overthinking every candle on the chart. Why do prices change? There are three simple rules behind price movements. Number one, price plus time equals value. Number two, certain price levels attract both buyers and sellers. Three, long-term participants create new trading opportunities. Sounds straightforward, right? But how does this actually work in real life? Think of a grocery store selling bread. In the morning, fresh bread is in high demand. People are happy to pay for it. By evening, the store wants to get rid of unsold bread, so prices drop. And midday? That's when supply and demand usually balance out, setting a fair price. Markets work the same way. Buyers and sellers constantly interact, shifting prices based on supply, demand, and time. To understand these shifts, traders use market data, a tool that tracks when and where transactions happen. One key method for analyzing this is called normal distribution, a way to organize price movements over time. We divide time into equal intervals and assign each one a letter starting with A for the first interval, B for the next, and so on. This helps us map out price changes in a structured way. On the graph, price moves up and down while time moves left to right. Think of it like tracking bread sales in a store. Most sales happen in the morning, fewer in the afternoon, and even fewer in the evening. If we put this on a graph, it would form a curve with a peak where most sales happen in lower points on the sides. The market works the same way. Prices tend to stay in a range where buyers and sellers agree, forming a similar curve. Understanding this pattern helps us see where price activity is most concentrated and where opportunities arise. And hey, if this explanation helps you see the breadth of market activity, smash that like button. For the love of fresh ideas and fresh bread. Let's consider an example with cars. What does a marketing specialist working for a car company do when determining pricing? Their goal is to sell as many cars as possible at the highest price so that the company makes the maximum profit, which is logical. But to determine the right price for cars, they track how many cars are sold and at what price. If cars are selling well, they may raise the price, but if sales start to decline, it may indicate that the price is too high and needs to be lowered. They also monitor which cars sell faster and which ones sells more slowly. If a certain model sells better, it means that people specifically want that model. In this case, the price can be increased to gain more profit. However, if the price of a car is too high, buyers may perceive it as too expensive at that moment and refuse to purchase it. Thus, the marketer's goal is to find a balance where the price is high enough for the company to make money but not so high that consumers stop buying. In simple terms, a marketer analyzes the market to set the right prices for cars and maximize the company's profit. Let's take an example of a person choosing an apartment in a residential complex. When buying an apartment, the buyer considers the price and time involved looking for the best deal. They analyze market trends to make an informed decision, while developers set prices based on demand and market conditions. Both buyers and developers influence the market without always realizing it. Let's look at three scenarios. Number one. Slow sales. If a developer sells under 10% of the apartments, buyers may assume prices will drop since demand is low. 2. Strong sales. If 80% of apartments are sold, buyers may realize prices are fair and might not drop, making it more urgent to buy. 3. Price discrepancy. If the market values the property lower than the developer's price, some buyers may profit by buying at a lower price and reselling later. What do you think? Write in the comments, guys. Would you buy early if you saw prices rising or wait for potential drops? Let's take a restaurant as an example. If a restaurant sets a price for food but struggles to attract customers, it probably means the price doesn't match what the market expects. These restaurants often deal with low foot traffic. On the flip side, if a restaurant is always packed, it's a sign that people think the price and quality are just right. Restaurants that require reservations are often the ones with great price to quality ratios. They manage customer flow efficiently, ensuring no one waits in long lines. But if a restaurant has constant long queues, it might be because the prices are too low for the quality of food. In such cases, the restaurant usually expands or raises prices. Now let's think about long-term market players. A good example is the US auto market in the 1950s and 60s. Back then, Detroit's big automakers controlled the market. It was stable and met the needs of short-term and long-term buyers. But when Japanese automakers entered the scene with affordable, high-quality cars, everything has changed. Consumers now had more choices, and Detroit automakers had to adapt, focusing on smaller, fuel-efficient cars and better quality. This shows how a new market participant with a long-term vision can completely shift the market. In every market, there are unique structures that shape prices and opportunities. Some changes happen often and have a big impact, while others are brief and less important. In short, understanding market dynamics helps you make better decisions, whether it's buying, selling, or analyzing trends. Keep an eye on how price, time, and participants shape the market. See you next time.